Welcome back to The Explainer, everyone. I am absolutely thrilled you're here with us today because we're tackling one of the most vital skills for any focused learner, demystifying corporate health. We're going to go way beyond the daily headlines and the market hype. We'll be using Southern Company as our primary case study to see how all the complex puzzle pieces of corporate disclosure actually fit together in the real world. Okay, let's dive into this.
So here is the ultimate question, right? If you're just looking at a ticker symbol dancing red and green on a screen, you know you're only seeing a tiny fraction of the story. To genuinely understand a company's resilience, its true potential, and its underlying value, we really have to parse through those dense corporate disclosures. We need to look at raw profitability, the financial safety nets they've built for hard times, and honestly, the actual humans steering the ship. So today, we're going to build a structured framework to help you find the real story behind that ticker symbol.
Now, before we get into Southern Company's specific numbers, let's just quickly establish a foundational concept, the price to earnings, or PE ratio. This simply measures the relationship between a company's current stock price and its earnings per share. Basically, it tells you what the market is willing to pay today based on its past or future earnings. A low but positive PE ratio, well, that might signal a stock is undervalued, meaning you're getting high earnings for a bargain valuation. On the flip side, if a company has a negative PE or a ratio soaring way over 30, it's typically viewed as a growth stock. That just means investors are betting heavily that the company is going to grow or become highly profitable down the road, even if it isn't quite there right now.
To systematically evaluate our case study today, we've broken our analysis into three logical pillars. First up, we'll look at financials and core metrics. Second, we'll evaluate their credit rating and liquidity. And finally, we will dive into governance and board diversity.
Let's move to Section 1 and see how this builds financials and core metrics.
When we look at the financials from 2021 to 2025, there is a very clear, powerful upward trajectory. Back in 2021, their net income was $2.39 billion. Fast forward to 2024, that number actually peaks at a massive $4.4 billion, ending 2025 extremely strong at $4.34 billion. This brilliantly illustrates a company scaling its profitability over time. And, we see this reflected directly in their basic earnings per share, too. That grew from $2.26 in 2021 all the way up to over $4 in 2024, before settling at $3.94 in 2025. This is exactly the kind of consistent bottom-line growth that really forms the bedrock of investor confidence. Moving right along to Section 2, credit rating and liquidity. So past earnings are fantastic, but what happens when the macroeconomic environment gets really tough? This is where we look at the safety nets. $10.5 billion. That is their total available liquidity as of December 31, 2025. To put that into perspective, that's literally more than the GDP of some small countries. Think about what this kind of a massive cushion means for a company's survival during a sudden economic crisis, or, say, a huge spike in interest rates. It means they aren't forced into a corner. It buys them time. It buys them flexibility, and it gives them the absolute power to weather macroeconomic storms that would easily sink their less prepared competitors. If we break down that $10.5 billion, they're holding about $1.6 billion in cold hard cash, backed by a staggering $8.9 billion in untapped bank credit. But it's not just about hoarding cash, it's about how the major credit agencies view you. Fitch gave Southern Company's subordinated notes a BBB- rating. If we actually dig into Fitch's scoring tool, we see they highly value the company's diversification and asset quality, giving it a very strong lowercase a assessment. This actually offsets a somewhat more moderate BBB score for raw profitability. And that balance right there, that is exactly what credit agencies are looking for when determining how resilient an enterprise truly is.
All right, let's pivot to Section 3, governance and board diversity.
Because at the end of the day, a balance sheet doesn't run a company, people do. Now, what's really interesting about this setup is that an overwhelming 92% of the board is completely independent. When you're assessing a stock, board independence is just a massive green flag. It ensures that the people overseeing the company's growth, risk management, and executive compensation aren't just in there rubber stamping whatever the CEO wants. Instead, they're providing crucial, totally unbiased oversight to protect your interests as a shareholder.
And that independent board, it is incredibly well-rounded. The company strategically blends hard skills, think deep expertise in government and public policy, with a highly diverse demographic makeup. We're talking 33% gender diversity and an impressive 42% ethnic and racial diversity.
This matters immensely because diverse boards have been repeatedly shown to avoid groupthink, they challenge core assumptions, and they identify complex risks that a completely homogeneous group might just easily miss. To bring this data to life a bit, let's look at one specific board member, Mr. Etheredge. He's currently a managing director at Monarch Private Capital, but before that, he actually served as the CEO for North America at Accenture. There, he was driving results for an 80,000-member team, executing a high-level strategy across consulting, technology, AI, cloud, you name it. When you have someone with that level of high-stakes, large-scale execution experience sitting on your board, it is just an incredible strategic asset for the current management team to lean on. And speaking of the management team, let's introduce Christopher C. Womack, the CEO in 2025. It is one thing to have a great CEO and a highly independent board, but the ultimate question for us as investors is always, how is this leadership team motivated? Are their financial interests perfectly aligned with yours? Let's take a look at exactly how this top-tier leadership team's compensation is strategically structured. So the crucial point is that executive compensation here is explicitly tied to two very strict goals: total shareholder return, or TSR, and return on equity, or ROE. Now, yes, they use some pretty complex Monte Carlo simulations to value all of this, but what it means in plain English is incredibly simple. Executive payouts are strictly bound to tangible returns for you, the shareholder. If the stock doesn't perform and the equity doesn't grow, those executives do not get their massive payouts. It's basically a perfect mechanism to align leadership motivations directly with investor success. We've definitely seen a lot of positives today, but thorough due diligence means we have to look at the shadows too. Consider this for a second. Do a $10.5 billion liquidity cushion and rapidly growing net income completely outweigh historical operational stumbles? For instance, if you really dig into the footnotes of their financials, Southern Company recorded a massive $1.7 billion estimated loss on plants under construction back in 2021. They marked it as a non-GAAP excluded item. It's a stark reminder that heavy infrastructure projects carry immense execution risk. As you move forward and evaluate your own investments, I really want you to ask yourself, how do you weigh the strength of an independent board and high liquidity against the ghosts of past capital losses? I hope this framework empowers your own due diligence. Keep learning, keep questioning, and thanks so much for joining me on this explainer.